Hi, my name is Kunal, and welcome to the Geeks of the Valley podcast, which connects with some of the brightest minds globally who are leading their respective industries today to discuss the hottest upcoming industry trends and how their work is affecting the global economy. This morning, from the San Francisco Bay Area, we have a prolific entrepreneur and highly regarded early stage investor with 3 decades of company building expertise, 25 years as an entrepreneur, and 13 years as an early stage investor. Please welcome NEA's venture partner, Ben Narasin. Ben, thank you so much for joining us today.
Thanks for having me on.
And how are things with you in light of COVID?
Well, we just got an announcement that at midnight tonight, we get to go right back into full lockdown, where the only thing we're allowed to do is pick up food, go grocery shopping, or go to the doctor. So, that's not exactly a high point, but we'll get through it, and next year will look more sunny.
Yeah, hopefully, the vaccine will come out soon and this will all clear up in the next few months here.
That's everybody's goal.
Yeah. Let's jump into the first question here, shall we?
Sure.
Tell me about yourself and your background and how it led you to the path of becoming a venture partner with NEA.
So, my path to being a sort of true venture capital investor was a long journey of entrepreneurship, 25 years as an entrepreneur. Took one of my companies public during the bubble, in the e-commerce space, and then spent about 10 years as a seed investor. And as a seed investor, I had a lot of companies that I would then introduce on to venture capital firms for their Series A's or B's or sometimes even C's. And through that, got to know a lot of VCs. And eventually, I had about $5 billion of IPO exits and another 5 or 6 billion of private exits. I got a lot of attention, and so different firms started talking to me. I started off as a general partner of a smaller boutique fund, and then joined NEA about three and a half years ago. Whereas a venture partner, I have a lot of flexibility. NEA was always on the top of my list of companies that I would refer my entrepreneurs to. I got to know over 300 VCs, 300 partners, and younger folks at sort of the top 15 firms. And when I would work with an entrepreneur who wanted to raise a round, I'd try to think about who the right people would be for them to meet. And NEA was almost always on that list. It's just a very high quality, do the right thing sort of firm, and the importance of trust and integrity to me is sort of paramount. And so that was why it was a great fit.
So, Ben, what is your personal investment philosophy? You've been in this industry for quite a while, and it'd be interesting to see how it's developed over the years.
Well, I've constantly evolved it in the sense that it's not an uncommon thing for someone to ask, but it was for a long time very hard for me to answer. And I finally came up with the things that mattered to me the most. And it boils down to, I'm not a thesis-based investor for the most part. Sometimes I'll have a specific thing I'm seeking out. But what I mainly am looking for is entrepreneurs to show me a new version of the world that I either hadn't thought of or had thought of, and they're coming at from a different angle. I often will say I'm looking for entrepreneurs that make me say, wow. And that's not easy. I mean, it's a volume game. I mean, you end up meeting a lot of people to get to those. I mean, I used to think about 1,000 companies a year was my standard number of pitches I would hear, but now I think it's closer to 2,000. With all the Zoom conferences and pitch sessions and every demo day getting bigger and bigger and bigger. And when I was seeing 1,000 companies a year, I'd probably fund 7 to 10, and now I'm seeing more than 1,000 companies a year, but I'm funding less. So it's just looking for those entrepreneurs that really stand out. And when I say stand out, there's 5 things that matter to me in any company. And I say this over and over again. I was just saying it today to one of my own founders who's now starting a fund of his own. People, a great idea, and a huge market. I pretty much need them all. On some occasions, the people will be so compelling, I will look the other way on the idea's greatness. But I generally find that to be pretty hard. I want to fund phenomenal people with great ideas. And those great ideas have to be going into really big markets, because otherwise, just the nature of how venture works and how I like to think about the world, capital, there's plenty of it out there, but for any one individual or fund, it will be finite. You can only do so many deals. More importantly, time is finite. And so if I'm going to get involved and try to help and put my shoulder in if needed, then I need to know I'm working on something really tremendous. And so far, I'm not a pushy investor. I'm not a person I'm not trying to insert myself, but I make it quite clear that if you need me, I'll be there. You tell me what you need me to do and I'll do it. So in that I know I'm willing to give an almost unlimited amount of time to my founders, I need to make sure that the opportunity at the other end is really enormous.
And I'm also guessing this was one of the reasons why you created pitchben.com, right?
Yes, it's now pitch-ben.com, little URL spoof there, but it's that is my way. So I've always thought that there was too much of a filter on Silicon Valley. You know, people had to be introduced in some way. They had to find their way into the firm, and some people probably had preconceived notions of what an entrepreneur would look like. I don't have any preconceived notions. I don't care if you're a purple octopus from Venus and you're sentient, but that's good enough for me if you're tenacious, smart, and driven with a great idea and a huge market. The rest of it is irrelevant. And so I wanted to make sure that anybody could get to me. And so historically, you know, like I have mentioned this to folks before, I read all my emails. I don't have an EA that reads my emails. I think my emails are my emails, and I read them all. It doesn't mean I respond to them all. You know, I might get 100 random pitches in a given week. I'm not going to respond unless they're interesting to me. I set up Pitch Ben because, you know, a lot of times I'd be speaking in a conference or doing a judging or on TV or something, and I would, people want to know how should they get in touch with you. You just said, you know, you want to make sure it's an open path. And I thought, well, if I just get a bunch more emails, that's going to be hard. And part of it is because people don't have a good ability in a lot of cases to sort of be concise. I say this as a guy that talks a lot. So Pitch Ben lets you go, pitch-ben.com. You go on and you can pitch me for 1 minute what your idea is. Now, hopefully you're telling me who you are, what you're doing, why you're doing it, who buys it from you, what they pay you. That's what matters. And I promise to give you 1 minute of feedback. Now, it's uncertain how long it'll take. It depends on how backed up things are. But this way, I'm forcing you to be concise and I'm giving you back something. Because if I don't answer your email, there's a lot of repeat till I finally have to hit unsubscribe or tell them why it's not for me. This way, at least I try to give some value. Another part of this is that giving value back. It's a pay it forward thing. It's a lower conversion rate than other methods of finding founders, but there's still companies I follow up with and want to learn more from. But I feel like if I can give people a window, you remember how I said I got to know over 300 VCs? Well, I learned a lot from them. I learned a lot about how venture thinks about the world. And I have my own way of thinking about the world, but it has been influenced by that. And I want entrepreneurs to understand what that looks like. If you're not in Silicon Valley, if you're in Uruguay or Florida, or just pick wherever you are, you know, you might not have a view other than having read something online about what it's like here and what people are looking for. Pitching venture capital when you don't have the right business for venture capital is just a waste of everybody's time. And sometimes simply trying to help people understand that other types of money could be better. You know, venture needs a certain type of return and a certain type of business. And it's the best when both parties are looking for exactly the same thing. Sometimes that's the message, and it's easier to deliver that when I've heard your story and I know if there's a fit.
And what type of business would that be?
Well, so the reality of venture capital, I've come up with a new rule. I'm at the formative stages, so I haven't tried this out publicly yet. I'll try it on you. I think of it as the 20 and a third rule. We'll see if it sticks. If 20% of the ultimate value that you believe you can create in your company doesn't equal 1/3 of the size of the fund you're pitching, you're not pitching the right fund. Because a traditional venture capitalist will end up buying about 20% of a company, and they need any company they invest in to be material to their fund. I think I'm being pretty lenient when I say 1/3 of the fund. I actually think it should be more. I mean, I think the best venture capitalists in the world want to believe that any deal they do could return the entire fund. But as a baseline sort of starting place, and maybe I'll change it to the 20 and a half rule. You know, if you think the biggest outcome you could possibly have if you do everything perfectly is a $100 million outcome, you do not want to be pitching a $2 billion fund, because 20% of $100 million is $20 million, and $20 million is not 1/3 of a $2 billion fund. You know, it's not even 1/3 of a $100 million fund. So a lot of entrepreneurs don't know that piece because they haven't spent time thinking about how venture operates. That's fine. It's not their job in the beginning to figure that out, but they should understand enough of it. You know, LPs give money to GPs, the venture firms, to invest on their behalf and then to give back to them plus more. And the failure rate, you know, the sort of quote unquote mortality rate of startups is high. And that's understood and expected. These are high risk businesses. You need to enter rational risk for ridiculous return. And the challenge is when an entrepreneur thinks that a good business or a good idea is one that would justify venture capital. It does not. I'm not in the good business. I'm in the phenomenal business. And the reason is that the other side of phenomenal is I lose all my money. And so if one side of the coin is losing all your money, the other side of the coin has to be a really large multiple.
And going off this theory that you'd mentioned, right? What have been some of your most notable investments till date?
I've had everything from, I mean, obviously not all of my companies are this way, but I had an 87x exit, a 58x exit, a 50x exit, a 55x exit, a 38x exit, 10x's. It varies all over the place. I mean, those are the true outlier successes, and those are a really important part of this business because you need them to get return on top. It's not just that if one company goes to zero and another company goes 2x, you break even. Nobody wants you to break even. They want you to give back a multiple on the fund. And these are long journeys. I have a company that I invested in that 12 years later sold for about $1 billion. And on a blended basis, I made about 6x. It's relatively low for that long and that sort of an outcome. I made about 10x on my first investment in their very first institutional round and about 4x on my second investment. But I have another company where it took 7 years and I made 87x. So, when it works, it can work at all different ranges. And those companies were both really exciting. Here's a great example of how challenging this is. I had two companies that started off doing different things. I seeded both of them. They ended up pivoting such that they were both doing exactly the same thing. I never talked to one about the other. They were friendly, but they were competitors. They were both in my winners column, mentally, not actually. One was doing 50 million in revenue, one was doing 100 million in revenue. They both sold within a month of each other. I made 58 times my money on one of them, the larger one actually. But what do you think I made on the other one? It was half the size. Did I make 29x my money on the one that was half the size as the almost identical business? No, I lost all my money. They sold for the debt that was on the company, and that was it. And that's sort of the reality of venture in my mind. You always have zero as a possibility. And so you've got to be very, very focused on that. Now, I'm not linking the different multiples to different companies, but Lending Club as an IPO was a great outcome. Dropcam sale to Google was a great outcome. TellApart sale to Twitter was a great outcome. Bungle sale to Blackstone was a great outcome. And there's quite a few more. Kabbage just had a great landing. There's just a lot of great companies. And actually, I'm, if not as proud or excited, maybe even more about a lot of the entrepreneurs that are in my portfolio right now. They're just keeping on going. It's like I don't have a specific near-term need for liquidity, so I just want my entrepreneurs to build the best possible business they can. And by the way, that's something entrepreneurs should make sure they're on the lookout for, is matching their own time frame with the investor's time frame. Because if you have a time frame that has short-term restrictions on their own capital, that wouldn't be true of a traditional venture firm that I know of, but maybe other types of investors, and you've got a long-term vision, that's challenging. But what's worse is when you have a short-term vision and your other folks need a longer-term, bigger outcome, that can create a lot of conflict.
And going off one of your points here, there are a lot of later stage investors, right, that sit and bet on the financials of a company rather than, here in the early stage on people and product, personality, etc., right? And there are a lot that just can't wrap their head around, these seed stage or pre-seed stage investors, right? And where does your confidence come from in operating in, this early stage market like this?
Well, I think everything, I don't even know if the word confidence is the right word. I'd say comfort. Um, comes from a couple of things. So it's intellectually a muscle that you build. Like success begets success would be the slightly more proud version of what I would say. But I think it's more about, the more you do something, the better you get at it. Now, in fairness, I remember, I'm not a golfer, but I took a golf lesson and I said, well, practice makes perfect. And he said, no, perfect practice makes perfect. Practice makes permanent. So whatever you do over and over again, you just keep doing. So I do try to be open-minded to always thinking differently and always learning. But the more you do something, the more comfortable you become with it. I was talking to a friend yesterday who had been considering raising an early stage fund, and I was talking about the same idea. And he said, I don't want to do it without X, Y, Z, a particular proprietary access point. I was like, why? He said, well, you just got to be out there pounding the pavement all the time, opening up opportunities. I'm like, that's the game. That's what it's about. Like, he's like, yeah, I know you love it and you'd be great at that. You are great at that, but I don't want to do that. So if you're not willing, here's an interesting comment. One of my partners said to me once. She came over and she said, I hear this was early in my career with a fund. And she said, I hear you just take more meetings than anybody in the firm. And I was like, well, I'm pretty comfortable with that. I like my calendar to be full. I'd prefer my entire calendar be blacked out all day. I don't like white space. That's not what I'm here for. He said, how do you do that? I can only take, like, let's say 2 or 3 meetings a day. And I said, well, it's, you just get used to it. You just do it. She said, it's just so, I forget the word that was used. It was something along the lines of demoralizing, because here's the reality for any investor. You spend all this time seeking this specific type of opportunity, and most of the time you do not find it, which means most of the time you're having to say no. The job of a venture capitalist, if you were to define it by volume, is to say no. Now, that's why a lot of people just won't give you an answer. My goal is I want to either pass in the meeting so I'm not a fit, or tell you I want to spend more time and learn more. Right. But when you have to spend all day saying no and all day finding things that aren't a fit for you, that can definitely wear you down. Now, it doesn't bother me for a day, but when I was exclusively a seed investor, I remember once I had gone for 6 months having not made an investment as a seed investor, where I'm doing 7 to 10 deals a year and taking more risk. And man, it just wears on you. But you have to have the discipline, because you have to remind yourself that when you start to make compromises, it comes back to haunt you later. You're on these journeys for 7 to 10, these days, more like sometimes 12 to 15 years. You need to be really picky, as the entrepreneur should be as well. Because, if you're going to spend that kind of time with somebody, you better make sure it's a fit. Anyway, the more you do it, the more comfortable you get with it. Here's the thing: there's two anchoring elements for me. I love entrepreneurs. I was born an entrepreneur. I'll die an entrepreneur. I'm just living vicariously through them. And having spent 25 years as an entrepreneur, I think I have a reasonable sense for what I'm looking for in terms of the human. Uh, was having a conversation with one of my founders, who I knew before I became an investor, and we were going through the portfolio just conversationally. I said, I've been doing this for 3 years, and I just had my first company fail. It feels to me like I'm being too picky. He's like, that track record is sort of something I've never heard before, but I'm not surprised. I was like, why? He said, I think you fund people like you. It's like, what do you mean? And he basically said, tenacious and driven and will never give up. And I thought about that, and I'm not going to take credit for all of those, but that is what I believe great founders have to have: that tenacity, that drive, that unwillingness to give up. Now, sometimes that means businesses that aren't going to make it last longer, and nobody benefits from that. But sometimes it's the difference. And so I think I've got a decent sense, but not good enough. It'll never be good enough. I don't know how to figure it out. You have a couple of hours with people, you do 4 meetings, you do 6 meetings. And you got to make a decision to fund. You really know if they're going to stick it out through all the hard times? It's a tough one.
It is. And at a high level, you are seen to invest in the SaaS and consumer internet verticals. What is your take on a global level on where you see these verticals moving in the next few years here?
I'm pretty open-minded on both vertical and a global expansion strategy. So first of all, on the verticals, like marketplaces, fintech, consumer, enterprise, it's all good. I used to say that I will look at any opportunity other than med tech and security, because I just don't have the expertise. But I actually just personally funded a med tech deal about 3 weeks ago. So it's the second time I've broken that rule. The first one was Omada Health, and they're doing really well. So maybe, rather be lucky than good. But I think it's the right entrepreneur with the right idea and it's just awesome. Both the opportunities that I'm in. So one, I don't think I'm concerned about any vertical I'm interested in weathering any particular storms. What COVID has done is it sort of pulled through digital adoption around the world and in every possible vertical. So whether it's consumer or enterprise, it just doesn't matter. It's all just been pulled forward. And people aren't going to go back to the way they did it before. There's just, my wife today was having a consult with somebody on a video teleconference, and she had to wait 10 minutes. And said, well, it's a lot better than waiting in the waiting room. Like, absolutely. Nobody's going back to dragging their butt to place X to do something just boring and stupid when they can just do it quickly online. And the nice thing is, most people, technically enabled people, have wanted to do that over time. It's just the businesses didn't enable it. Now the businesses have no choice, so they're all doing it. And so I think that will stick. Secondly, I think the world has become insanely flat compared to even when that concept first came out, because let's face it, it seems like most of the planet at this point has Zoom. So getting connected is quick and easy and pretty painless. And you can do it around the world. I've judged startup competitions in a single day from probably 4 or 5 different countries, and seen 10 or 12 companies in each. So I'm getting access at a level, far beyond anything that even pitch-ben.com enabled me. So I really like that a lot. I think there's great opportunities can be created almost anywhere in the world. I think some places have trended hotter than others, but this diaspora out of Silicon Valley of talent will certainly create additional value in a lot of other spots, including spots that are already quite valuable. You also have the sort of the efficacy of remote work is becoming very obvious to many people. And that means that you can have sort of talent from anywhere in the world helping you with something, or you can start a business and have that virtual company. In the old days, people would be concerned if you didn't have your team under a roof, but now they get that, you can get the best people from wherever the best people are. So I do think you're going to have a lot of folks creating a lot of interesting things. I'll make a last point here. I think that COVID is going to create a just absolute explosion of both traditional and micro entrepreneurship. You just have the combination of people that aren't working by choice or otherwise, who can come up with their side hustle or ideas. And you have all the people that are working from home with nobody looking over their shoulder. So the amount of time and intellectual capital that can be put into starting a new business has never been higher. And a lot of those side hustles are going to turn into something more than a side hustle. Now, there'll be plenty of micro entrepreneurship. That's what Shopify has enabled and others. But amongst those micro entrepreneurs, there will be the ones that break out and have a business that can scale even beyond that. And I think that can come from all over the place. I mean, you just that's where you get to a truly global economy and a global entrepreneurial base. I'm not going to move out of Silicon Valley anytime soon, but I like that I have access to the whole world. I used for the 2 years before COVID, I was traveling all around the world, primarily throughout Europe and the UK, looking for new opportunities where there's a sort of real blossoming of things happening. But now I can get it all from my library. That's great.
And going off this COVID point, with the pandemic and high living costs, right? Big companies of all sizes, which have made up the valley, are moving out. Is there a new up and coming valley where most VCs will be in the next few years? If so, where would that be? You got the Greater Bay Area with Guangzhou, Shenzhen, Shanghai, right? You got Singapore. You got a variety of new opportunities out there.
Well, I don't think Silicon Valley is at risk. I think you will see a significant amount of movement, a lot more than we've ever seen in the past. Here's what happens. Every time the tax status changes or is threatened to change, certain types of people and certain types of businesses say, if you do that, we're going to have to leave. But they never do. But this time they are. And it's not just the US, it's California. California is being extremely punitive in how they're handling their tax strategy, particularly for affluent people. And that is going to drive people out of here, as you've already seen. Now, having said that, you've got a supply demand disequilibrium that's so out of whack. A lot of people can leave this area, and there's so many that want to come here. I can't imagine it's going to create a meaningful divot. What it will do, though, is create all kinds of promising areas. Globally, certainly, as you mentioned, quite a few places, but locally, a lot of people are going to Austin. Austin's a great spot. I used to go to Austin once or twice a year. It's a really vibrant community. And I had founders, I had a pair of founders, two guys graduated from Stanford. They immediately moved to Austin because they felt they could get high quality labor, technical labor and non-technical labor at much more reasonable costs. And they've stayed there ever since. They built a really solid business. They sold it for a lot of money. They did very well. They're now investors, and one's helping the political landscape evolve. So, Austin's very promising, but people are moving to all kinds of other places. If you want to see where the places will do the best, look at the tax code. Because if you move out of Silicon Valley, like I moved out of New York City and I ended up in Incline Village, Nevada. What a beautiful spot. I wanted to stay there. After about 3 years, what we realized is the schools weren't what we wanted, so we kept looking for better schools. But if you're leaving California, which is probably the highest tax region in the country right now, I'm guessing you're probably looking at the low tax regions. And Texas happens to be one of those, and so Austin's a great fit. But could be Washington State with Seattle. And what you need when you move somewhere as an entrepreneur or as an investor, Zoom's great. But if you're building a business, you need a wealth of talent, and that usually comes from high quality universities in the area and other high quality businesses in the area that will have folks, sort of a tail of folks that spawns off of it that can either start a business or work for another upcoming business. So like when I was in Europe, as an example, one of the things I was trying to figure out is how they could get the sort of hyper growth people that I was accustomed to seeing. And I talked to a lot of folks, particularly some that had set up shop in Germany, and they said, look, we can get phenomenal founders and executives, and we can get plenty of rank and file. It's that middle layer that's hard. It's hard to get the people with the actual been there, done that experience of hyper growth, to steal Reid Hoffman and Chris Heath's term, for blitz scaling, I guess is their term, that type of entrepreneurial talent. And so a lot of them would go to the UK because the UK had a more developed entrepreneurial ecosystem. The entrepreneurial ecosystem in Germany is great. It's just developing people that have already done it. You don't want to be learning for the first time. If you're driving a car, you want to learn at 10, 20, 30 miles an hour. You don't want to jump in a car and floor it to 170 going around a curve and figure it out as you're going. And that's where some of the challenge of other areas have had. But the Bay Area has an incredible density through both serendipity and just the magnetic field that it exerts of people that have that experience. It's very much Florence during the Renaissance. And now people are looking for other areas, but I think it remains a pretty strong region. I'm not particularly worried.
So Ben, for startup founders listening to this podcast, how do you recommend they approach their first few rounds of financing, whether it's a convertible, an equity round, or investing by common shares, etc.? And what method do you suggest using? Is there an incentive to using one method over another over the course of the investment period?
So I think it's a great question. Talking about a few rounds is probably harder, but let's sort of go round by round. A lot of folks, when they raise their first round, their pre-seed or their seed, typically, by the way, people will do a friends and family round, bringing together money from the people they know and they can scrape together to sort of do an early prototype or just enough to show people what they're doing. And from there, they're going to go to either a pre-seed or a seed round. Most people will go with a convertible note or a safe. Personally, I still prefer that they go ahead and do an equity round. There's freely available documents out there. It used to be seriesseed.com. And basically, all the law firms have put out these open access documents to do equity rounds at virtually no cost. So, I don't think it's required that in order to save a lot of the money that you go and just do it. So net convertible notes are about making it cheaper. And there's an old saying, fast, cheap, high quality, choose any two, right? And so when it's fast and cheap, you're probably giving up the one that's the most important. And so the reason I like entrepreneurs to consider doing an equity round right from the start is, think about it this way. When are you going to have more time to deal with all the little nuances of getting everything documented correctly? Now? Or when you're in the frenzy of a successful Series A, if things go well for you? Well, you're clearly going to have a lot more time now. Also, it's not going to be that much more expensive if you handle it with the open source documents. It used to be all the law firms published them. Now the NVCA has standard docs they put out there for free use, which is great. They're very fair. They're very rational. They're sort of plain vanilla. But also there's sort of benefits to the investors and to the entrepreneurs as well. There's things in the tax code, at least in the United States, for what's called QSBS, and the clock on that doesn't start ticking, like your capital gains clock doesn't start ticking until you're an equity round. Your convertible note doesn't count towards your tax status. So imagine that you sort of missed a major opportunity to save money because you got where you needed to get in a period of time, but it was half of it was as a convertible note. Anyway, there's a lot of reasons I don't love convertible notes, but it can be very fast. It can stop the valuation discussion. But here's the thing. That's one of the reasons people usually say is, oh, I don't want to have an argument of valuation. Well, you're going to put a cap on the note, right? Well, nobody believes they're going to raise it less than the cap, although I have seen it happen. So just make the cap the valuation. Now, when you get to a Series A, if you're dealing with a tier one firm, you're going to do an equity round. You're going to do it on the combined negotiation of the two of you going back and forth to figure out the right structure. They're also pretty plain vanilla, but miraculously, everybody has a lot to say. I mean, I guess lawyers have to get paid, but I'm always blown away when somebody gets a plain vanilla document and comes back to me as their seed investor, as an example, to ask me for advice on stuff. And I'm like, are you really telling me the lawyers care about this stuff? There's a lot of stuff that sometimes I'm stunned at. If you're really worrying about, whether your investors have registration rights during the IPO process or whatever it is, it's like, Series A, and you're worrying about that. Okay, well, these documents tend to be, if you're dealing with a tier one high quality firm, you're getting very fair documents and you're tweaking around the edges. So at that point, it becomes less of an issue. And the further out you go, the more, it's not that it's all homogenized, it's that you have different choices. Here's the reality though, it's supply and demand. If you have a lot of people demanding what you have to sell, the equity in your company, and you have a modest supply of it, then you can dictate your terms pretty aggressively. If you don't, you're probably gonna get trapped in the golden rule, the old fashioned saying that the person with the gold makes the rules. So, I'd prefer equity to safes, but safes are better than the old fashioned convertible notes. And convertible notes are fast and cheap. They're going to have some disadvantages.
And Ben, to wrap up our call with our last question for the day, we have a question from a fellow listener of ours. And this question is a bit long, and please bear with me. The question is, As a young individual trying to jump into the VC industry, is starting as a VC abroad in maybe a low income or mid income country a negative to your career? And then seeing if you can come back to the Valley as a VC. Some would say that you are only as strong as your VC network, which is abroad and no use to the Valley, while others may say you attain some interesting VC experience on how to take companies from 0 to 1. And that international experience would be interesting for a Valley based VC fund to have. And this then also comes down to that aspect that, right, the VC community in the Valley is very closed and tight knit.
So I think serendipity plays an important part of our lives in general. Luck is required as an entrepreneur, and luck's required in your career. So the reason I bring that up is if you are a VC in a region that becomes exciting to VCs here, then all of a sudden they're going to care a lot about their access and their network there. And that can be very advantageous. If you're a VC in a region that is not of interest now and not of interest later, it will be harder. But I do think it teaches you many valuable lessons. I mean, there's sort of venture is a challenging job to get, and a challenging job to keep, by the way. But it's always better if people at least know a lot of the basics. And so you sort of have a choice when you're bringing somebody in, depending on their role. If you're talking about, there's a big difference when you're coming in as an associate or a principal or an analyst or a partner, et cetera, et cetera. But generally speaking, like the reason that today venture capitalists, a lot of the tier one venture firms that have associates recruit through the tier one banks is they know the people they're recruiting already know how to do all the analytical work, which will aid the partners that are working on the deals. And so that's important because it frees up partner time. You've got smaller funds that are looking for different things. Your network is always important. But at the end of the day, if your experience brings you value and helps you succeed, well, there's 2 points here. One, if you end up doing a phenomenal deal, like one of those rocket ship companies everybody cares about, that probably creates more value for you than anything else you could do in terms of getting yourself a career in venture. But secondly, I remember reading a quote recently, I don't know who it came from, but they said there was a key piece of advice they were given. It was a woman who said that at one point, she said someone told her to stop focusing on the jobs that she thought would get her to the next jobs and focus on the job that would give her the skills to succeed in the ultimate job she was looking for. I believe she was the CEO of, I forget, a Fortune 100 company. And I thought that was really a great statement. You have to have the skills, you have to have the experience. Remember when you asked me earlier, how I filter or how I feel I have any expertise at all, or how I do in seed, where it's a place a lot of people won't tread, and that volume. There's I forget which book it is that's one of these things that you can read the first chapter and you read the whole book, but 10,000 hours to become expert at something. There's a lot of truth to that. Whether it's 10,000 hours exactly or not, I don't know. But as I said earlier, practice doesn't make perfect. Practice makes permanent. Perfect practice makes perfect. And getting the opportunity to have perfect practice means you've got to have a role to allow you to do the things to learn what is right and what is wrong so you can correct. Right? So it seems like a perfectly valuable and valid way to go. In my view, I think your questioner has a reasonable idea there. And if they happen to have serendipity and luck come their way, they'll be in a region that will become the hot region of venture capital in 3 to 5 years, so that everybody will want them for the network that they have. That would be a nice bonus.
Ben, for people who are interested in, me a sec here. Ben, for people who are interested in reaching out to you or maybe catching a cup of coffee with you, what would be the best point of contact?
Tough to do coffee in COVID. But I think today, the reason I put that www.pitch-ben.com site up was explicitly for that. It's anybody can go on, send me a pitch, and I promise to give them a response. It's usually guidance and feedback and advice. But sometimes it's let's spend more time together on this. Let's figure it out. I think it's a great way to start. www.pitch-ben.com. Happy to listen to anything. As a request, it is meant for pitches. And pitches are going to tell me more about you than anything else will. So remember that it's who you are, what you do, why you're doing it, who you're doing it for, and what they're paying you. It's not a sort of meandering discussion about what life might bring and how you might be able to take advantage of it. have a hard time giving people any sort of valid advice back on that sort of thing.
For listeners out there currently listening to our podcast, details on Ben will be attached in the podcast notes. Ben, thank you for joining Geeks of the Valley, and it was truly a pleasure having you here.
Thanks for doing it. Really enjoyed it.